Welcome back to the StockSpy, your 5-minute stop for smart financial investing. Today we are going to uncover one of the world's most valuable companies, Apple. But here is a twist. While the headline talks about innovation and AI, smart money is starting to look uneasy. Let's decode why Apple, yes, Apple might be headed for a near-term fall. Stick around because we are about to reveal some insider signals and Wall Street moves you won't hear on the mainstream media. Apple is often treated as an untouchable, a stock you buy and hold forever. And for the longest term, that belief made sense. Apple delivered massive gains over the last decade. iPhones, AirPods, Apple Watches, and a growing service business all contributed to its trillion-dollar valuation. But here is what's happening now. Apple has underperformed the global market in 2025. As of this week, the stock is down nearly 19% year to date, while other tech names like Nvidia, Microsoft are still posting gains. Why the sudden lag? It starts with growth. Apple's core business, the iPhone, it's maturing. Unit sales are plateauing and incremental grades aren't driving the same buzz of revenue growth. In fact, in the recent quarters, iPhone sales have slightly declined year over year. Services, once a high growth segment, are still expanding, but at a very slow pace. When the two largest drivers of your revenue are flattening, Wall Street notices this. This week, Needham analyst Laura Martin dropped a bombshell. She dropped Apple from a buy to a hold. Her reasoning? Martin believes Apple now carries more downside risk than an upside potential. She estimates a possible $20 to $30 drop per share in the short term, while upside is limited to just $15. This is a very bold call, and she's not alone. Several institutional analysts have started trimming their exposure to Apple, citing valuation concerns. Apple is still trading over 28x forward earnings, while its growth is more in line with value stocks. The math doesn't lie. When your growth slows, but your valuation remains high, the stock eventually needs to adjust. And often that means a pullback. But here is where things get even more interesting. Apple has largely missed the AI wave, or at least hasn't caught it the way Nvidia, Microsoft, or Google have. Unlike Google and Amazon, Apple doesn't operate a cloud business. And while Siri was early in the voice assistant game, it hasn't evolved much in the recent years. AI is very expensive, and without a way to monetize it directly through services or cloud infrastructure, Apple risks burning cash on R&D without clear return. Investors are beginning to realize it. Laura Martin's downgrade specifically mentions that Apple's AI investment could become cost center while the competitors turn their into profit engines. Unless Apple delivers a game-changing AI reveal in the upcoming Worldwide Developer Conference, this narrative could hurt its stock even more. Apple's exposure to China is another red flag. While most of its products are assembled in China, Apple also generates a significant chunk of its revenue from Chinese consumers. Chinese economy is slowing. Tensions with the US remain high. There's also a global push within China to promote domestic brands like Huawei and discourage foreign tech usage. Earlier this year, several Chinese government agencies reportedly banned iPhone for employees. Moves like this, even if it's symbolic, can hurt the demand of and investor confidence. If this trend escalates, Apple exposure becomes a serious liability. Apple's upcoming Worldwide Developer Conference scheduled for next week could be a make or break moment. Rumors suggest Apple may reveal a new AI-enhanced version of Siri, more powerful M3 chips, AI-integrated productivity tool for iOS and macOS. These could spark renewed interest in Apple's innovation story or disappoint, confirming that Apple is falling behind in competitors like Google, OpenAI, or Amazon in the AI race. Investors will be watching very closely, but expectations are real high, and anything less than a game changer could lead to a selling pressure. Now let's talk about what smart money is doing. While insider selling hasn't spiked significantly, there has a steady drip of executive level stock sales over the past few months. Nothing suspicious, but very consistent. Also, several hedge funds have rotated capital into other Magnificent Seven stocks like Nvidia and Alphabet. Apple is no longer the obvious tech play for institutions chasing alpha. All of these are quiet signals, but ones you don't want to ignore. So here is the bottom line. Apple is an incredibly strong company. It still is. But as of now, the stock may not reflect the risks. Slowing growth, AI monetization gap, China exposure, and the valuation stretch. Our recommendation for long-term investors, hold if you believe in Apple's innovation roadmap. But in short term, be cautious. Our risk-reward model estimates a 60% chance that Apple underperforms the broader tech index in the next 3 months. This doesn't mean panic, but this just means you might want to watch from the shadows before jumping in. If you find this insight valuable, consider joining the StockSpy network. Like, comment, and subscribe for weekly breakdown of the market moves and forces shaping them, all in under 5 minutes. This is StockSpy, where we decode Wall Street one clue at a time. Thanks for watching.